this is Savitcharjan Ron Singh recording our weekly session of Charts Are Fun. This is for the week of November 11th. I'm recording this after market close on November 15th. Well, last week the market had shot up after the election results. Huge expectations of a pro-growth president, re-elect President Trump. This week it took a bit of a breather. The markets pulled back. This was options expiration week, so Powell was a bit hawkish, I could say, less dovish on his Dallas meeting presentation yesterday. He said that there's no rush for Fed to cut rates, seeing that inflation seems to be still reasonably high. CPI came out at 3.3% this week year over year, and PPI came at 3.5. Market, would love lower rates. The CME FedWatch tool expectations changed quite a bit. We'll show a little bit of that. So we're going to show the CME FedWatch tool. We'll look at the S&P 500 to past, rate hike cycle or rate cut cycles and how the steepening of the yield curve has impacted the markets. We know that we just about from an inverted yield curve had uninverted, and now we just above the flat line, gone positive, the 10-year minus 2-year. But we'll look at where that's headed. Look at the 10-year chart. We'll look at small caps, which tends to be very sensitive to interest rates. So with the yields continuing to climb higher, the 10-year yield, in particular long-term yields going up closer towards the 4.5%. In fact, it did start 4.5 pullback and close slightly below it. We look at where the small caps are headed. Software stocks were on an absolute tear for the last few days, ever since the election. We look at where till yesterday it had gone up, and then intraday pullback yesterday, and then the pullback continued today. So look at the iShares Small Software ETF IGV. Look at the core holding there, which is the largest holding, close to 10%, Salesforce. Its chart. Palantir, of course, has been on a tear. It's not the largest. It's about 4% of the IGV ETF. We'll look at that. Story stock, of course, and has done extremely well since earnings last week. In particular, got a big climb today, even though the market was down, primarily because of they are moving from New York Stock Exchange to Nasdaq. This means more ETF buying. There are a lot of Nasdaq-based ETFs, index-based buying comes into Palantir, and they go into effect November 26th. So this is going to add near-term momentum on Palantir. Though it's gone parabolic, I wouldn't touch it here. There's a good chance it may have a sharp pullback because valuation-wise, completely, like nothing but crazy speculation causing it to keep climbing higher. And then we look at the semiconductors, the big week next week with NVIDIA's earnings on the 20th, which is next Wednesday. We'll look at the SOXX, which is the iShares Semiconductor ETF. NVIDIA is the biggest holding in that. So we'll look at what that NVIDIA chart looks like in that. NVIDIA is almost over 10.3% in there. And also look at the SOXX chart itself and then end with that. With that, let's just share the screen. So our YouTube site and our blog site, the blog site is chartsarefun.substack.com. We publish daily blogs. Appreciate you subscribing with your email. You'll get notified as soon as the blog comes out. This is the archive button, like tab in there, shows all our blogs. This has been a service we've been doing since mid-February this year. So several blogs you'll find interesting in different trends and patterns we talk about. The YouTube site is also Charts Are Fun. At Charts Are Fun is the channel. Appreciate you subscribing to the channel. And then if you like the videos, if you would give the like button, we'd appreciate that. So as I said, Chair Powell had a speech in Dallas. This is the Dallas regional kind of forum. And this is the part of the speech where he says the risk to the economy is not sending any signals that we need to be in a hurry to lower rates. This is kind of a hawkish message. Fed had done a 50 basis point cut in September. 6 weeks later, Fed followed with a 25 basis point cut in early November. The next one is coming up in mid-December. And market's expectation, which is the CME FedWatch tool, it puts a probability on the next cut. We can see that till yesterday, it was at 72% of a 25 basis point and 27.8 or 28% of no cut. That shot up to now 41% or 42% of no cut and 58. So the 72 came down to 58 of quarter point cut. So the market is now a bit unsure what the Chair Powell and the Fed is going to do. If inflation continues to be hot, if the job market doesn't slow down much, even with both the dual mandate there's no big rush for them to go about cutting rates further. The neutral rate is what, of course, the market has been talking about. Many expect it to be 2.9 to 3, but more and more it's looking like it could be higher. It could be closer towards the 3.5. Jeremy Siegel, the Wharton professor, was on CNBC this afternoon, and his targeted neutral rate, whereas Fed will cut and kind of stop or take a pause for now, would likely be towards the 3.5 to 4%. Typically, we look at the inverted yield curve, which this is a long-term chart we're looking at since 1975, so almost a 50-year chart. And we can see that every time the vertical line in purple shows that every time from an inverted to an uninversion and then a steepening of the yield curve happens, S&P initially has a pullback, and then maybe depending on the economy and so on, it may rise. Same thing. So this happened in the early 90s, then in 2000 after late, the dot-com crash into late 2000 to 2001. We saw that the steepening happened, the market pulled back quite a bit. So 2001 through 2000 to 2002, that was a big pullback. 2007 stopped to 2009 March. That was also a very sharp pullback. In those two pullbacks, both, we saw that there was steepening going on while the market pulled back. 2020 is more of a special year with the COVID collapse and so on. Initially, though, before 2020 collapse, when the market was climbing, the yield curve had already kind of touched the zero line. It hadn't fully inverted. It had kind of flattened out between the 10-year to 2-year. This curve on the bottom is the difference of the 10-year, which is really what the yield curve measures, the difference of 10-year minus the 2-year. So it had come down towards the zero line, as in the 2 and the 10-year were about the same yield. And then from there, it started steepening. But that we did get the COVID collapse, and then it sharp rally after that. So even though the yield curve was steepening, it didn't matter. The market kept climbing. Now we're just about, from a span of almost 2 years, we were inverted. So 10-year minus 2-year was negative. We finally turned positive. We are at 0.28 right now. But as this steepens, it's been interesting to see, as like in the past, if you do get an initial pullback in S&P. And that typically happens when the economy is kind of showing signs of slowing down. So this is the 10-year minus 2-year, just looking at the, monthly chart. Every candle here is a month. And we can see that the trend is now from a negative, right? It hit a low of minus 1.46 towards early 2023. It has since then been trending higher, as in higher lows, higher highs. And right now it is at the 0.28, but had recently touched as high as 0.23, which is 10-year yield was 0.23 higher than the 2-year yield. It's right now 0.28. It had hit negative briefly after the election results last year. Well, no, this is not after. This is monthly, not weekly. So this was towards call it sometime in October. It had hit negative again, but then since then closed up positive, and it's been now kind of towards the right above the zero line, held up positive. So this breaks out, it can go back towards the 1.6 to 1.7 level. That's where typically it has traded. We've had a 2014 through 2018, we've had, of course, a declining yield curve. The 10-year minus the 2-year has been coming down from a 2.7 difference to minus 1.9. From there, it had shot up to 1.6. So we got to see. The 20-month moving average is climbing. The 50 is kind of flattening and kind of, could start moving higher as well. And with that upward trend, if the yield curve steepens, we got to see what the market does. 10-year yield in particular has a cup and handle, not a very typical cup and handle where the left rim is slightly higher towards 4.29. But if you take from the gap here near 4.12, the base of the cup, the bottom of the cup is at 3.6. Very sharply had come to 4.12. So that's roughly, you're talking about 5.2. 5.2 added to 41.2. In fact, 36.03 to 41.03 is actually 5.17. 5.17 added to 41.2 measures to 46.37. Isn't it magical that it's very close to the previous May high at 46.38 within a cent of that? So 46.38, 46.37. So that's where we think, though there is negative divergence, RSI showing lower highs, PPO is in the midst of negative crossover, going below the black, going below the red, and the histogram going below the zero line, which means we could perhaps have yields coming lower. But near term, there's a possibility there could be some more upside. There's been a sharp climb, of course, from that September low of 10-year yield near 3.6. We touched 4.5 this week's. In fact, today we had touched 4.5 and then closed below 4.5 at 4.42. So something for us to be cautious about. But with this negative divergence in PPO, this might be a point from where we could perhaps get a 10-year yield coming down. And that's directly correlated to the small caps. They don't like high interest rates because these are companies that need to raise capital. They are usually the balance sheets aren't as strong as the large, big, huge mega caps. So they need to raise for their growth, need to raise capital often, and high rates are not good for them. So that said, this week, of course, had huge gap up on the Trump election results when Trump was reelected. We see heavy volume, the big breakout. This is the classic ascending triangle pattern, by the way. It shared this last week as well. 227 is the resistance. Higher lows as we see from 196, 203, 214, 217. That breakout measures 258. We got to 242, pull back, testing that 20-day moving average and holding above it. This could be a gap fill, and then from there we could see a climb, and that could time with the 10-year yield coming down. That's what I'm expecting. If the 10-year yield, because of this negative divergence, the target not too far high from here, another maybe 10 or 13 basis points from 4.5 to 4.63, then we get a pullback in 10-year yield that could be correlated with a small cap ETF, the Russell 2000 ETF IWM, climbing back, and this time going towards that target of 258. So near-term trading opportunity might not be a bad idea. We know that Tom Lee is often talked about. He's very bullish on small caps. If you look at their median P by E, way below the median P by E of S&P 500. So there's a possibility that you could get multiple expansion and small caps could benefit from it. And then also, if a pro-growth Trump economy with, taxes being tax-friendly and so on, corporate taxes are supposed to go down further towards the 15% is what he's kind of promised. And that could all be very good for continued growth in small cap. We know that the RSI was strong, pull back to test the neutral level at 50, and could be a great point from where it could reclaim the climb. So you've got to see what small caps does next few days. The software ETF, which is the iShares software ETF IGV, this has got 113 or so stocks in it. This is, in fact, if you look at the prospectus, the largest is Salesforce, and then Oracle, Microsoft, ServiceNow, and so on. But if you look up on the top here, this is roughly, you're looking at number of holdings, 113 stocks. PY ratio is definitely a lot higher. So small software stocks, as we know, tend to have very high valuation because they grow stronger. So if you look at the semiconductors P by E, which is like the SOXX, and we can just quickly see the corresponding SOXX's portfolio here. The largest of SOXX is, by the way, NVIDIA. But if you look at SOXX, there are 30 or so stocks in that, 30 stocks. The P by E is 34, versus the P by E on the softwares is 65. Almost a little less than double of the valuation of the semiconductors. With that, let's look at what the IGV chart is saying. This is a very long-term chart. Every candle is a month. So this we can see at 89 to 90 level, there's a resistance level, multiple times it tested, and then these kind of ascending lows, higher lows. So that's why it's an ascending triangle, higher lows with a resistance line of 89 breaking out. That measures to 130. It tested 105, 106 recently, 105.89, pulling back last couple of days, but there could be some upside on software stocks, something for us to look into. So the key largest holding in that ETF is Salesforce. This is a bit of a cup and handle, more of not a symmetrical cup, but kind of a slanted cup, but 289 on the left brim. The low is at, roughly 211 or so. And then the high on the right brim is 294. So that's roughly 83 points added to 294. That measures closer towards the 378. We tested 348, pulled back to 325. It could resume the climb. If IGV climbs, Salesforce could continue climbing towards the 378. So this is a bullish sector overall. The other thing to keep in mind is IGV's relative performance to S&P 500 has been pretty strong. This is, of course, a long-term chart. We're looking at from 2012 to 2000, so about 12 years, a monthly chart. It's kind of outperforming S&P by 92%. So Salesforce, however, though it's the top software stock, on the daily chart, and in the daily chart, we're looking at the last 7 months or so, it is still below S&P 500 relative performance. It's at minus 4%. It has, in fact, ever since that gap down from 289 towards the 211, it started underperforming, touched the bottom for scraping the bottom of that relative performance chart for several months till it started climbing more towards October into the November timeframe. Post-election is where the real climb came. Still, so far, negative relative performance to S&P 500. AD has now finally begun to climb at a higher high from the previous AD, which means some accumulation is coming on, bit of a pullback in profit taking, but there's a gap slightly here, could close, and then we could see a resumption of software. Palantir is a story stock. I talked about them being added to the Nasdaq index. Very bullish momentum. It's AI, of course, written all over it. Huge growth, close to 45 to 50% growth, both on the commercial and the government business. Is supposed to be a pro-Trump stock. Many believe that Peter Thiel, their original investor, is a pro-Trump entrepreneur. Their CEO, of course, has been extremely bullish about the fundamentals of the company. He believes that they got it right. They understand what the needs of the customers are, and they will continue to add and contribute towards the business success with AI monetization. So this is overbought, no question. We can see RSI on the daily at 83. We can see PPO has climbed to 11, extremely stretched out. At some point, we'll get a pullback. At the minimum, we'll get a pullback towards the rising 20-day moving average at 52, and potentially can't rule out a test towards the 50-day. Now, both the 20-day and 50-day are climbing. So by the time the pullback comes, there's a good chance now that we will see that 45 level from where the gap was left. That's the top of the gap from when after earnings it shot up. So 45 could now expect it to be a reasonably good support level. So the 50-day could climb to 45 by the time we see the pullback. So if you're waiting to buy Palantir, expect to see that pullback, test 45, and that could be a good entry point for Palantir. With that, I had talked about the iShares Semiconductors. These are 30 holdings. The biggest stock there is NVIDIA. We know that their earnings is next Wednesday, the 20th. There's been a bit of a laggard. We can see that with all the strength, even though it had climbed for 4 successive days last week, then from there onwards, it's been flattening, and now it pulled back to test the rising 20-day. Of course, the 20-day is above the 50. They're both climbing, so that part is bullish. However, we can see that RSI was so much stronger in the previous climb in the May to the June timeframe. Versus RSI now, we can see is lagging. It's holding just below 70 to the 50, and range bound between 50 and 70. So it needs to see, maybe, we have heard that CapEx spending by all the hyperscaler clouds are huge. Microsoft, Google, Amazon are all spending big on NVIDIA GPUs, and of course, potentially it's possible that the business could still yet to be very strong. So we'll see what happens on the earnings, but the ascending triangle on this, with about 140 as the resistance level, higher lows from the August 5th low at 90, 100, 115, and so on, measures to 188. Now, that could be huge. It has been in the 3.5, 3.6 trillion. That'll put it to 4.2 trillion if it can get there. It has been a story stock. It has been tremendous beneficiary of the AI spending that across the world people are doing, and we'll see what they say about their. Now, the only thing is one of their suppliers that or rather buying their GPUs and then kind of selling it out in the cloud for fashion is SMCI, and that had it had a lot of negative news with their auditors kind of leaving the supporting the company. They've had financial irregularities, and people are really concerned about what's going on in terms of governance and the way the company is reporting earnings and so on. So that is a bit of a dampener on NVIDIA because they buy quite a bit of chips from NVIDIA, but there are others that buy NVIDIA chips. So it may or may not really cause, because as we see, SMCI pulled back a lot, as we know, in the last few weeks, but it didn't really change much to NVIDIA's bullishness. It's holding above the 140 level, closed at 141.98, closed right above the 20 was 141.5. It closed above the 20-day moving average, 141.98. So bullishness remains till the point that this breaks. If this breaks, then we can look for a pullback to 132, and that could mean that 132 to 149 could be head and shoulder maybe. So 132 could be a test. go right shoulder at 144 and then a pullback. So 130 to 149, talking about 17 points. 17 from 132 takes it about close to 115. That's where around 15 right here. I don't know. It looks like there's a good chance that it may have a bullish result next week, and then the momentum could take it towards 188. We got to see. That said, if you look at the semiconductor ETF SOXX and look at how it has been doing, we can see that the AD on this had peaked out in the July timeframe, and from there it fell quite a bit into August 5th. It's kind of plateaued out. It tried to climb in the October level, and then from there again flattening. We can see relative performance to semiconductors S&P over the last 7 months is down 15%. Relative performance to software, the iShares Semiconductor to the iShares software is down 20%. So all kind of slanting, going from from the call it the upper on the left to the bottom on the right. That's the clear decline on the relative performances. Something for us to look at. And also it broke below the 216 key support level and closed towards 211. That from 216 to 240, you're talking about roughly 24 points. 24 points from 216 would effectively put it down towards the 192 level, which is what we have seen in the August 5th. Something to watch. SOXX is not looking good from a chart perspective. In many ways, it is potentially predicting a breakdown, and this breakdown measures to 192. So if NVIDIA will, of course, have strong earnings, but it does not beat the whisper numbers, it shows any signs of slowing down of their astronomy growth, then we could see NVIDIA breakdown along with taking the semiconductors down. Something, for us to watch next week. Be very cautious trying to pile on to the semiconductors till we see the earnings come out and see where it's headed. So to sum it up, key earnings next week from NVIDIA, the bellwether of AI spending, also the semiconductors. Watch for this break of. It did break with a gap today, and it kind of broke below 216, closed at the lows of the day 211. But if the NVIDIA earnings on Wednesday is bad, or if there is any further selling onto before the earnings of the next few days, Monday, Tuesday, Wednesday next week, look for this to break down to 192 would be very bearish. So something for us to be very cautious about on the semiconductors. With that, good luck trading next week, and we'll talk to you the week after. Thank you.